Welcome back. Now, Reunert has posted a 21% decline in interim headline earnings per share, driven by a challenging trading environment in which led to the delay of key projects, which had a material impact on the group's half-year earnings. Despite this, a dividend of 90 cents was declared, reflecting an increase of 8.4%. Company CEO Alan Dickson joins us for greater perspective on the performance. Alan, thanks so much for your time this afternoon. As mentioned, key metrics there in the red. You described the reporting period as challenging. Just walk us through the 6 months that was.
Yeah, perfect. Thank you very much, and thanks for having me. And we had guided when we spoke in November that the macroeconomic environment in South Africa was challenging, and that has remained throughout the 6-month period. And it really centers around GDP, which drives our ICT and renewable energy businesses, and then gross domestic fixed investment, which drives our electrical infrastructure businesses. And all of those metrics either remained flat or decreased slightly during the period. But most of our businesses in that tough environment pretty much delivered results that were in line with the prior year, but we had 4 specific issues that played out which do not repeat. The first of those is in the last period we had a healthy COVID insurance payment, which wasn't repeated this year, so that inflated last year in comparison to this one. The second one was we had a significant defense contract which was deferred, and it's important, it's deferred, not delayed, and it's deferred into the second half. The third one is we had our battery storage business, which continues in the absence of load shedding to be under a great deal of pressure. And on that, we have chosen to exit that business, which should be concluded shortly. And then finally, the electrical infrastructure projects that you spoke about, those were also delayed. So the performance really on those 4 issues were the reasons for it, and 3 out of those 4 issues have been dealt with.
And just on that disposal of Blue Nova Energy, are you not seeing any upside at all, and that's why you're choosing to sell it?
No, I think over the longer term, battery storage is still a market that will play out. But when we look at it and we look at how it was going to play into our renewable energy strategy, we were an early entrant into that market. We don't think we're the best player to deliver the value out of that business over the longer term, and hence the decision to exit it now, as we believe the new buyer will be a better player to maximize the benefit out of that business.
All right, so the defense cluster is still proving, to be a winner for Reunert amid the geopolitical tensions we are seeing. Talk to me about where you are seeing the most demand.
We have 3 key markets. We have Southeast Asia, the Middle East, and Europe. And in fact, across all 3 of those markets, we are seeing good demand at the moment, particularly though in the Middle East and Europe. And Europe for different reasons. Obviously, there is some real political issues over there, or geopolitical issues over there that are playing out, and that's a demand for our product. But also into the Middle East, where they are building new defense industries, and our intellectual property and our products are finding strong demand in that market as well. So those would be the 2 markets that are delivering the biggest demand for us at the moment.
And despite, seeing lower earnings, the balance sheet seems fairly solid. You're at a net cash position as well. How much of that are you setting aside for CapEx, and what projects will you be investing in particular?
So we've got 3 clear strategic initiatives. We are investing into digital integration, which we believe is a long-term trend, and in our ICT businesses, particularly in what we call our solutions and systems integration cluster, there we are investing for growth into that environment behind that sort of global trajectory. The second area is our international revenues, and that's primarily behind our defense and electrical engineering industries, particularly in circuit breakers. And our third is into renewable energy, where we're investing specifically into solar energy assets that we own and then sell electricity to customers on the back of long-term PPAs. So those 3 areas are the areas that we are specifically investing into for growth, whilst obviously continuing to invest into our existing assets to ensure they remain appropriate for what we've got. So those are the key areas of growth, with the final one being ensuring that we have sufficient cash and capability to continue to return value to shareholders through consistent dividends. And again, you've seen that we've held that dividend flat this year despite a tough 6 months.
And walk me through the growth trajectory you are expecting to see from the solar business, even as we've had less bouts of load shedding in 2024 and in the beginning of 2025.
Sure. So our solar business operates exclusively in the commercial and industrial market vertical. So we're selling effectively to businesses. In our view, not in our view, factually, many of those businesses sit on municipal grids. And what those businesses are seeing is rapidly escalating electricity costs. In many cases, service delivery from some of those municipal infrastructure environments is very challenging. And we also have some load curtailment. So the rationale for business to continue to invest into solar assets or renewable energy assets remains very strong. And we continue to see a medium to long-term demand for that. What we are noticing, however, is that the growth rates, where we had a very rapid growth, say over the last 5 years, and because we're on a much higher base at the moment, the extent of that growth going forward from a year-on-year growth point of view is likely to tail off a little bit, still showing good growth, but not at the call it double-digit levels that we'd seen in previous periods. But certainly that C&I space, in our view, continues to be a healthy environment, and we have a strong pipeline of delivery into that market.
All right. And sticking with, just the outlook, talk to me about what you're seeing in terms of growth prospects for that power cables division.
Yeah, so that power cables division, and there's two businesses in there. One, we have a manufacturing plant in Zambia. So into Central Africa, there is actually a very solid growth environment. We see quite a lot of investment into the copper infrastructure, the copper mines in Zambia itself and in its surrounding areas, and that continues to provide good and consistent returns coming out of Zambia. So that has its own sort of growth trajectory. And then the big kicker for us really comes in South Africa, where we have seen significant green shoots and considerable work on a range of projects across the national grid, which has to be expanded, but also new investments into our ports, into our logistics hubs through the rail environment that we've got, and into water. Increasingly, we're seeing around that being driven actually right from up to the presidency. And all four of those areas require significant electrical investment and significant investment into power cables specifically. Now, what we're experiencing at the moment is that we're moving steadily towards that, but the kickoff of those projects are just somewhat delayed. But we believe for sure that that will take place and it will accelerate over ahead, and that will really be a big boost to that cables business.
All right, Alan, thanks so much for your time and taking us through the 6 months that was. That was Reunert CEO Alan Dickson.